What if there was a way that you never had to pay capital gains on crypto or even real estate, eliminating the need for 1031 exchanges? The ultra rich are selling million-dollar assets and paying zero capital gains tax, while regular people get hammered with rates up to 37% on short-term gains. You sell your crypto, your stocks, your rental property, whatever it is, and the IRS comes knocking for their cut. Most people think there's no way around paying 20% or more to the government when they cash out, but if you're dealing with short-term gains, you're looking at up to 37% going straight to Uncle Sam. But here's the thing, the ultra-rich have been using a specific strategy for decades that lets them legally avoid these taxes completely. I'm talking about a combination of something called a legacy preservation trust paired with life insurance that creates a system where you can essentially sell your million-dollar asset and never pay a dime in capital gains tax. I'm going to show you the exact mechanism they use and how this whole thing works. So let's start with what makes the legacy preservation trust different from all other trusts you might have heard about. The key difference is how you can sell your appreciated assets to this trust without triggering any capital gains tax whatsoever. Here's how this works. Let's say you bought some crypto 5 years ago for $100,000 and now it's worth $1 million. Normally, if you sold that crypto, you'd be looking at paying capital gains tax on $900,000 of profit. But with the Legacy Preservation Trust, you can actually sell that wallet to the trust for the original $100,000 you paid for it. Now, you might be thinking, wait, that doesn't make sense. Why would you sell something worth $1 million for $100,000? Here's where it gets interesting. The IRS has these rules called grantor trust rules, and what they basically say is that for income tax purposes, you and the trust are treated as the same entity. So when you sell your wallet to the trust for $100,000, there's absolutely no capital gains tax triggered, because the Legacy Preservation Trust is a non-taxable trust. The IRS does not see it as a taxable sale at all, since you're technically just moving the asset from your left pocket to your right pocket. But here's the genius part. Even though the IRS treats you and the trust as the same entity for income tax, they treat you as separate entities for estate tax purposes. So the trust now owns this appreciating asset while you basically owe yourself the original cost basis of $100,000. Here's another important piece most people don't understand about how trusts work from a tax perspective. Since the Legacy Preservation Trust is a non-taxable trust, the income generated by the trust is not taxed. Capitalizations and endowments are also non-taxable events. This means that when you contribute assets to the trust or when the trust receives payments, they aren't considered taxable income. The trust operates in a completely tax-free environment, which is what makes this strategy so powerful. Let me give you a real example of how this plays out. You transfer your $1 million crypto wallet to the trust for the original $100,000 you paid. The trust now owns crypto worth $1 million, and you have a note receivable for $100,000. No capital gains tax triggered because those grantor trust rules. The crypto continues to appreciate inside the trust, and let's say it goes to $2 million over the next few years. All that growth is happening inside the trust, completely outside of your taxable estate. This strategy works for pretty much any appreciating asset you can think of. Business equity, rental properties, stock portfolios, art collections, you name it. The key is that the asset has to have appreciated significantly from when you originally bought it. Now, you might be wondering what happens to the $100,000 the trust owes you. This is where the life insurance component comes in, and this is really where the magic happens because you need cash flow after you've transferred your asset to your trust. You can't just live off IOUs from your own trust. The trust can pay you back over time with interest, but here's what most people don't realize. You can structure the payments in a way that minimizes your current tax liability while the assets continue to grow inside the trust. Some people set up installment payments over 10 or 20 years. Others structure it as interest-only payments for a period of time. The flexibility is pretty incredible, and that all depends on your specific situation and cash flow needs. Now that you've got your assets safely tucked away in the trust, you need a way to access cash without creating taxable events. This is where permanent life insurance becomes your tax-free ATM, and honestly, this part is pretty brilliant. Here's how the life insurance piece works. You take out some of the cash flow and trust payments, and you fund a permanent life insurance policy. Not term insurance, but permanent life insurance that builds cash value over time. The cash value grows tax deferred, which means you're not going to pay taxes on the growth year after year like you would with regular investments. But the real magic happens when you need to access the cash. Instead of withdrawing the money from the policy, you could create a taxable event. You take loans against the cash value. These policy loans are never considered income by the IRS. Think about that for a second. You can borrow hundreds of thousands of dollars against your life insurance, and the government doesn't consider it income at all. Let me walk you through how this creates infinite liquidity. Your assets are continuing to grow inside the trust tax-free. Your life insurance cash value is also growing tax-deferred. When you need money for living expenses or new investments, you simply borrow against the life insurance. The loan doesn't stop the cash value from continuing to grow, and you never have to pay it back during your lifetime. This creates what I call a double compounding effect. Your original assets are compounding inside of your life insurance and compounding separately. You're essentially getting growth in two different buckets while having access to tax-free cash flow through the policy loans. The beautiful thing about policy loans is that there's no credit checks, no income verification, no approval process. It's your money and you can access it whenever you want. Some policies let you borrow up to 90% of the cash value, and the interest rates are usually pretty reasonable, often lower than what you get from a bank. Here's another powerful feature of the Legacy Preservation Trust setup. You can actually MEC an insurance policy inside of the trust itself. MEC stands for Modified Endowment Contract, and what this allows you to do is dump significantly more cash into the policy than you normally could, while still maintaining the tax-free status of the loans. This means you can build up massive cash value inside the trust that grows tax-deferred and remains accessible through tax-free policy loans. Now, here's something most people don't understand about these loans. The insurance company isn't actually lending you your own money. They're lending you their money, and they're using cash value as collateral. This means your cash value continues to earn whatever the insurance company is crediting while you're using the loan. Now, here's what most people don't understand about these loans. The insurance company isn't actually lending you your own money. They're lending you their money and using the cash value as collateral. This means your cash value continues to earn whatever the insurance company is crediting while you're using the loan for whatever you need. The compounding never stops. The cash value keeps growing uninterrupted, even though you borrowed against it. This is the key to the infinite liquidity concept. Your money keeps working for you even when you're using it. The cash flow system becomes even more powerful when you consider you never have to sell appreciating assets in the trust. Those assets can continue to grow for decades while you live off tax-free loans from the life insurance. And remember, since the trust owns the assets, they're not part of your taxable estate, so you're saving on estate taxes down the road. Now, let's talk about what happens when you pass away, because this is where the strategy really shows its power for building generational wealth. When you die, the assets in the Legacy Preservation Trust transfer directly to your beneficiaries, and here's the key part. They receive what's called a stepped-up basis. This means that all of the capital gains and accumulated over the years get completely wiped out for tax purposes. Your heirs inherit the assets at their current fair market value with no capital gains tax liability whatsoever. So going back to our crypto example, if that $1 million crypto grew to $5 million, by the time you pass away, your beneficiaries inherit a $5 million cost basis. If they sell it the next day for $5 million, they pay zero capital gains tax. All of that appreciation that happened over decades gets transferred tax-free to the next generation. The assets also bypass probate completely, which means they transfer directly to your heirs without going through the court system. No probate fees, no delays, no public records. It's a completely private transfer that happens according to the terms you set up in the trust. And here's where the life insurance really shines. Remember those policy loans you were taking during your lifetime? When you die, the life insurance death benefit pays off any outstanding loan balances automatically. Your beneficiaries get the full death benefit minus any loans, but they also inherit all the appreciating assets in the trust with a stepped-up basis. This creates maximum wealth preservation for the next generation. Instead of paying capital gains tax that could eat up 30 to 40% of your wealth, everything transfers tax-free to your heirs. It's like turning what would have been taxable events into completely tax-free inheritance. So there you have it, the three-part system that the ultra-rich use to legally avoid capital gains tax. You set up the legacy preservation trust, transfer your appreciated assets at the original cost basis, and then use life insurance policy loans for tax-free cash flow while everything grows outside your taxable estates. Now, I want to be super clear, this is educational content only and not financial advice. All these strategies are very complex and they're not the right fit for everyone. You do absolutely need to work with experienced professionals who understand the tax code and estate planning in your state. But if you've got significant appreciated assets, this could potentially save you hundreds of thousands or even millions in taxes. If you want to see more wealth advanced strategies like this, make sure to subscribe and let me know the topics you want to cover next. And if you want to reach out about setting this up or seeing what it looks like for your specific situation, there will be a link in the description.